This is Bonds 101, starting from scratch. A bond is basically a loan. Everybody's familiar with their mortgage. A mortgage is a bond. You borrow money from a bank to buy your house. Corporations borrow money from pension funds, individuals, to build new plants, to pay for employees, to pay for whatever they need to pay for. Governments sell bonds to pay for their needs, whether it's military or welfare, whatever a government needs to do to cover the needs that aren't met by the immediate tax income to the government is made up by selling bonds. The U.S. government is probably the champion bond seller of the world. Every month they're selling, well, the number varies depending on their needs, but anywhere from 35 billion to 135 billion, and sometimes more, sometimes less. We're kind of going through a funny period right now where they're starting to sell less because of the tax increases and the savings from the sequester. But let's get back to the simple stuff here on the bond side. So everybody knows what a bond is. Now, bonds have various maturities. We're all familiar with your mortgage. You have a 30-year mortgage or a 15-year mortgage, which basically says you loan, or the bank loans you the money for 30 years, and you use it to buy a house, and you pay it off slowly over those 30 years, along with principal, which is the original loan, plus the interest that the bank demands for lending you the money in the first place, which oftentimes can be fairly significant. There's something in the bond market. Obviously, we're going to start talking about U.S. Treasury bonds now, since that's what most people in the capital markets are trading. U.S. bonds are sovereign debt, and they're from a sovereign nation, the United States. Most every country in the world has, their own bond issues. Most people are familiar with German bunds or British gilts, French oats. They all have their own sovereign debt. All debt structures from 0-day maturity, or 1 days, 2 days, 3 days, you can borrow money over those maturities, have different names. Treasury bills are very short term, from 1 day out to 1 year maturities. Treasury notes go from 2 years all the way out to 30 years at this point. The bond market has grown quite a bit over the last 20, 30 years since I've been in the markets. These days, a lot of trading, more so than ever before, is going on in exchange-traded funds. You can track darn near every bond type and maturity through ETFs. We trade U.S. government Treasury bond and note futures, which trade on the Chicago Board of Trade at the CMEgroup.com. You can look those up. The CME Group website has a ton of information in terms of bonds and bond futures options. It'll get very complex as we move forward through these lectures here. I need to keep this kind of short. I've already gone a little bit long. That was Bonds 101. We look forward to hearing questions, any ideas you guys might have, so we can expound on these little lectures that we're going to have over the next couple months. Thank you very much.